Hi, everyone. Welcome back to Signal or Noise. This is episode 15. Charlie Bilello here, and joining me as always, Peter Mallouk. Peter, we have a lot to talk about today. I want to start out with the markets. And what I say to investors entering every year is expect the unexpected. And boy, do we have a series of unexpected events this year. I'm just going to run through a few of these here and then get your thoughts. We have the Fed, of course, hiking rates 4 times this year, more than expected entering the year. We have 10-year treasury yield higher, went as high as 5%, and recently it's come back down, but still higher on the year. And then lo and behold, that did not prevent the S&P 500 from rallying over 18% on a price basis, over 20% on a total return basis. And remember that earnings recession from last year that everyone expected to continue this year? Well, we have a complete recovery now in terms of S&P 500 operating earnings, trailing 12-month earnings hitting a new high in Q3 of this year. And the fascinating thing, Peter, and this wasn't supposed to happen, was that not only are stocks higher, interest rates higher, Fed funds rate higher, but we also have multiple expansion. So S&P 500's PE ratio has actually gone up this year, 9% to 21 times earnings. None of this was supposed to happen entering the year. And of course, we were supposed to have a recession as well. That hasn't happened. What are your thoughts in terms of expecting the unexpected as an investor and what's transpired this year?
Well, first, everything's completely unpredictable all the time over a 1 year period, even over a 3 to 5 year period. And this year is just evidence of that. Like you said, everyone's coming in, they're expecting higher interest rates and that we're going to go into recession. It might be a very, very rough landing. Instead, looks like a pretty soft landing. We might be near the top of interest rates. The market sees that moving up ahead of that. But if we peel back the onion a little bit, it's not as amazing as it sounds. We're still not at an all-time high in the markets. All we've done basically is remove the losses from last year. So you have 2 years of zero, right? You have 2 years of nothing happening, but it looks awfully good when you look at just the 11 months of this year by itself. Also, if we take away, the Magnificent Seven, the seven biggest stocks in the S&P 500, the performance has been very mediocre. If you move down to small cap stocks, they're still 24% off their all time highs. A lot of overseas indexes far off their all time highs. So it, it's not what it appears to be, but it's still better than expected.
Yeah, no doubt. So on that point, in terms of unexpected things happen every year, and this is the time of year where it kind of starts. And there's a headline that caught my attention that we're going to talk about. But every year, there's this prediction game that goes on. Wall Street loves it. Every different big Wall Street bank is putting out these forecasts. What's going to happen in the following year? And as an investor, really what you have to try to do is not fall prey to acting based on these predictions. You can listen to them, you can read them, you could try to view it as entertainment, but acting on them is not going to be a successful strategy. And here's why. Looking at 2024 prediction here, this really caught my eye. Deutsche Bank is topping all of the investment banks in terms of predicting where the S&P 500 is going to be next year, which is obviously an unbelievably ridiculous thing to do, to try to predict an exact point at some point in the future, exact level where the
Right.
S&P is going to be. But they're saying it's going to go to 5,100. And they're kind of hedging that bet, saying, well, there's also going to be a mild recession next year. How they know it's going to be mild, I have no idea. So what I did, of course, is go back. Well, how has Deutsche Bank been in their predictions in the last 2 years prior to that? Is there any credence to listening to what they're saying? If we go back to 2023, entering this year, what was Deutsche Bank saying, Peter? They're saying the stock market was going to fall 25%. There was going to be a recession this year, which obviously hasn't happened, and that earnings were going to plunge. And we just showed that earnings actually went up. And so, okay, maybe everyone gets it wrong sometimes. What did they do the year before entering 2022?
Uh,
Well, they were extremely bullish. The market was up a lot in 2021. They said S&P is going to hit 5250. Earnings are going to be strong. What actually happened in 2022? The stock market had its worst year since 2008, and earnings fell. So I know you've written a lot about this in your books, and you talk about this all the time. But the prediction game is always going to exist, and it's obviously amusing to you and I, But for an investor, it's really confusing, isn't it? You're hearing all these different things from
I mean,
supposed experts.
yeah, to think that if over the last 2 years you, went against their predictions, you were a 75% probability of being right. I mean, to be wrong twice in a row is spectacular fashion, by the way. Not just wrong, but, like, wildly wrong. Let's hope, for investors that they're wrong, that they're right this time for the first time in 3 years.
Absolutely. So Deutsche Bank, I just picked it because it stood out there in terms of their prediction for next year, but they're not alone. Entering this year, and we talked about this earlier this year, but now 1 month ago, stock market's up over 18%, as we talked about. What were strategies collectively thinking coming into the year was actually predicting the first down year in decades in terms of their predictions. So not very useful. And what I like to tell people is the worst possible thing that could happen is you're following this advice and it actually transpires. It actually works out,
Right.
whether it be a stock pick or a forecast, right? Because then you think, oh, this person knows something, they have special information, and I'm going to act on that. And that's a very dangerous game for investors to play because obviously we know no one can consistently predict the future and they're going to get it wrong eventually, right?
Well, this is where the biggest problems actually happen when you have somebody that's repeatedly right. So, for example, you take Leg Mason Value, Bill Miller, the only fund manager in history to be right 15 years in a row, beat the S&P 500 15 years in a row. So people say, hey, look, you can predict this, you can beat the market. At that point, he saw peak inflows. So who was there in years one, two, three, four, five? Nobody, right? All the money goes in after you've broken all these records. And what happened after that? Bottom 1% performance. So the majority of people that invested in that fund were economically devastated, and very few people were there when it was going up. So that is the danger. It's very much a coin flip. If you have thousands and thousands of brokerage houses, mutual funds, hedge funds flipping coins, of course there's going to be a couple people that get heads 10 times in a row. All the money goes into that. The odds catch up with them and the majority of investors get punished. You see that with the ARC funds now. There's always an example, one after the other, where we can watch that happen.
Right, which just shows you that if they do get it right in the short run, it's more likely to be luck
Right.
than skill, and therefore you really shouldn't be following something that's just based on luck. All right, we've covered that plenty here. Let's talk about how much you can comfortably withdraw during a long retirement. This is kind of blown up on FinTwit, Peter, as you probably know. Dave Ramsey made a comment on his show. He was asked a question. Well, you have a 30-year retirement, and the person asking the question said, "Well, what's a reasonable withdrawal rate?" I heard 4%. We've all known the 4% rule, which is simply taking out 4% of your nest egg. So if you have $1 million, you take out 40,000 in year one, and then you adjust that higher over the retirement for inflation. And Dave Ramsey did not like that 4% rule, to say the least. Yeah, I'm just going to run through some of his comments and I want to hear your take and then I'll dig into some of the data. He said, if you're making 12% in good mutual funds, and he always talks about this 12%, and that's what he's making, you need to leave 4% in there for inflation raises, and that leaves you 8%. So he's perfectly comfortable drawing 8%. But if you want to be a little bit conservative, only 7%. He's calling the people who talk about this 4% rule goobers. He's saying that most years in his portfolio he's actually done better than 12%. He's easily making 12% and simply stay away from the 4% withdrawal rate morons, he called them. So, what do you
Yeah,
have to say? You have a 30-year retirement. Do you think that an 8% withdrawal rate, and here he's assuming a 100% stock portfolio, by the way,
right,
do you
right,
think, what's your take on a lot of these comments here? We can take it bit by bit. What's your overall take,
right.
though,
Well,
on 8%?
so my take is nuanced here, especially compared to everything you see on FinTwit, where the second he said this, I mean, he just got you know crucified by thousands of people just jumping on him. Let me first say this: I think Dave Ramsey has done a lot of amazing things for probably over a million people. I mean, he's really changed the way they handle their money. He's excellent at debt management. If you look at the number one way families get into trouble is the debt gets carried away from them. We all know about compounding. We talk about monetary growth all the time. but it works in reverse. If debt gets away from you, that debt can really compound and you could never survive. And he's helped families manage their debt, think about it properly, get out of debt, and live much better lives. So I think very highly of what he's accomplished with all of those things. Now, when it comes to investing, very different deal here. So first, it's pretty widely accepted that if you're looking for a safe withdrawal rate, and you have people even say 3, some people say 5, but, no one's saying 7, and no one is saying 2, right? And it's quite simple. The expected long-term rate of stocks, depending on what you're looking at, is 7 to 11%, and of bonds, depending on what periods you're looking at, are 3 to 6%. You put together a portfolio, and of course, you get to a number that a relatively conservative withdrawal rate would be around 4 to 5%. And part of the reason for that is what we call sequence of return risks. If you go into the market and you're invested in all stocks and the stock market happens to be right before 08, 09 or the Great Depression, and you've got a withdrawal rate that's higher than that, it's not going to work. It's not going to work. That's not debatable. It's just not going to work. Now, he's unique in his remarks in a couple of ways. Most retirees are not 100% equities. There is a lot of research that says you can be 100% equities if you can control your withdrawal rate and still get a better return over the long run. Like you can have all the money you need and have your portfolio grow. It's just as somebody who advises tens of thousands of families and sits across the table from people every single day. I don't know too many people who can withdraw money from their portfolio and be 100% equities. So let's take 08, 09. The stock market was down 53%, but that's large US stocks, which were the second best performing stock market in the world after Japan. If you had international stocks, you were down more than 60%. Small cap stocks at one point down more than 70%. If you've got a portfolio of stocks, you start your retirement with $1.5 million and you're at 600,000 and you're withdrawing his recommended 12%, game over. You are running out of money. 100%, you're running out of money. So, that piece of advice that, hey, in retirement, you can withdraw 8 to 12% and not have any issues, it's just not good advice. Now he's saying, look, I've earned more than 12%, rate of return over the long run. And I'm sure he's got one mutual fund that, over some period of time had done that. But we just got done talking about the selection process of funds. You and I know that over 90% of mutual funds have underperformed the index over the long run. The index's long-term rate of return is less than 12%. So just one piece of very bad advice from somebody who's done a lot of wonderful things for a lot of people. I'm curious your take, having done so much research on withdrawal rates.
Yeah, so you hit the nail on the head in terms of sequence of return risks. If he could actually make 12% a year every year, then the math would work out. But the problem is, A, we know 12% is actually higher than the long term return for the stock market. And maybe he's done better. We can't verify that than the average person, but he's saying it's not, we know it's not, definitely not very easy. But if the stock market is going up 10, 15% every year, yeah, you'll probably be okay with a very high withdrawal rate. The problem is heading into retirement, you don't know that, and if you happen to retire of a deep bear market, well, now let's say your portfolio is cut in half. You did the 2008 example, and then you're taking out another 8%. Well, that's going to be difficult getting back, right?
Right.
And if there's something like the Great Depression, which I'm going to show here, well, then you're wiped out in 8 years, right? So is this a base case scenario? No, but the Great Depression wasn't the only time period where your money would have ran out before 30 years. Morningstar John Rankenthaler did a good analysis looking at this, and he showed 1960s, 1970s. We know periods of high inflation, stock market returns weren't very high. Also, the early 2000s, right before the dot com bubble crashed, you would have run out of money as well with this high of a withdrawal rate. Just looking at the S&P 500 and being 100% in terms of equity. So what you're doing in terms of withdrawal rates is you're kind of playing the odds, right? And the odds suggest that if you're going to take out 8% a year, it could actually work out. And what Rankenthaler showed was that 55% of the time, your money would actually be okay, right? For
Yeah.
that 30-year period. But here we're talking about someone, let's say, who really needs that, right? And you're
Yeah.
living longer than expected. 30 years is longer than the average retirement. Well, what happens if you're in that other 45% of the time, or you're in that situation where 6% of the time it doesn't even last 10 years? Well, now you have a real problem. So to say 7% is conservative, I think that would be a little bit of a stretch, but I don't think you want to make your retirement a coin flip, particularly for people that need it, right? Dave Ramsey's obviously has enough money where none of this matters, right?
Right.
That's the other thing. If you have hundreds of millions of dollars, it doesn't really matter, right? You could take out, you know, a large sum of money. He obviously has a large income as well, even though he's saying he's in his 60s and he could comfortably take that out. Well, he still has a big income, right? All of that math changes the equation. But I don't know if you want to do a coin flip, let's say, or that would be responsible advice to say do a coin flip for your retirement in terms of will you have enough money to get through it.
Yeah, if you don't have peace of mind, you don't have anything. And you can't have peace of mind thinking there's a 55% chance things are going to work out for you in retirement.
Yeah. So he called them nerds, goobers. That all of that might be true, but sometimes you have to do a little bit of math. And the truth is, we don't know what's going to happen with the market in the future, which is why a little bit of
Uh,
conservatism can go a long way. And like you said, maybe it'll come back, right? So, like even in the 2008 example, you probably would have been okay. Because the market did come back, but you didn't know that at the time. And imagine the panic you would have felt if you had an extremely high withdrawal rate after that year, in terms of worrying, oh, am I going to have enough? Okay.
right.
So let's move on to the secrets to a happy life. I want to start out talking about a recent survey, 2,000 Americans, Peter, where they asked, uh, what income what increase in your income would you need to feel happy or less stressed? And they did this for all different income ranges. The median income in the survey was $65,000 per year, and though that group said they would need an income of 95,000 per year to feel happy and less stressed. That's a 46% increase. But the real fascinating thing, Peter, here is that the highest income cohort here, 250,000 per year, this group was earning. They also said they would need a huge increase, 40% increase to 350,000 in order to feel happy and less stressed. And that's pretty incredible. You would think that above a certain amount, the percentage would go way down, but that to me was pretty surprising outcome. But I guess it shows that you really adjust your level of happiness very quickly when you get a raise or you get a higher income.
I'm not surprised at all by this, and I've read so much. We had a lot of happiness speakers at our events where we do a lot of obviously finance, economics, but then we break it up with health, wellness, and happiness. And so I've read a lot about happiness, and when you look at the common theme across all these people at different points of view about it is you cannot be happy if you are not content. And that the reason the vast majority of people are not happy is because they're not content because they're constantly resetting their expectations. And this is a great example of it. No matter what income group anybody is in this survey, they're no longer content because they find themselves comparing themselves to a new group of people. They have lifestyle creep where they've gotten used to certain things. Now they aspire to other things, or they're trying to keep up with the Joneses. Whatever those three reasons it is, they've reset their expectations. And so this survey, and it's interesting to me, it was what would make you feel happier and less stressed, right? So basically, what would make you feel more content. And so I think that as soon as all of these groups, if we gave all of these groups exactly what they want today, and they went right to that level, this same research tells us they would all immediately reset their level because they would no longer be content after a very short honeymoon period. And so that's the issue: is this we immediately move up, reset our expectations across the board, and it creates this perpetual discontent.
Is there any way to counteract this, or is this just human nature? It's never going to change. I mean, how should one think when they get a raise? How should one change their thinking in order to feel more content, as you say?
Well, I think there are all kinds of things that help people manage this. So you talk about every time you get a raise, you disproportionately increase your savings rate. So yeah, you have a little bit more money coming in to do things you want to do, but you all while that's happening, you haven't taken the whole increase. What you've done is you've disproportionately increased what you're deferring into the future. So you're not immediately absorbing that shock of the new raise or the
Mm.
inheritance or whatever has happened. You've apportioned some of it off. And then also figuring out what's your comparative circle, because it every time anything happens, you move to a new neighborhood, well, you've got a new circle you're comparing yourself to. You go to a new church, temple, whatever, you've got a new circle of people you're comparing yourself to. You walk into a new job, and really stepping back and comparing yourself to where you were 5 or 10 years ago, where you originally wanted to be. Reframing the comparative group is obviously a very big part of this. If you can't do that, you'll never get anywhere, because there's always somebody with a bigger house or a better car, whatever it is that you're aspiring to.
Yeah, and on that point, there's always someone. This is kind of a shocking study. It doesn't just apply to income; it also
Yeah.
applies to net worth and wealth. And this 2018 study asked millionaires to rate their happiness 1 to 10, 10 being the highest. If they didn't say 10, they then had to predict how much more money they would need to move just 1 point higher on that scale. And over half of the people with a net worth of above 10 million, so we're talking about, top 1.1% of the population here, said their wealth would need to increase by 50% to just move up 1 point. So, like, these people have made it, right? They should be by all means content, and they're saying they would need such an increase in happy to affect their happiness. Like, to me, that's shocking. They're just, I guess we'll talk about in a little bit the secrets to the happy life, but in your interaction with people in this group of wealth, how do you talk to people? And this is obviously a great advantage to have for people, but how do you talk them into saying, "Look, appreciate what you've accomplished here. Like, you
Yeah.
should feel you already won the game, right? You should feel content. Now, just find ways to have a more meaningful life with this money." Is that enter into the discussion in terms of advising or talking with people in this? Because you would think they should be feeling pretty good about their situation, but it seems to be the case that oftentimes they're not.
I do bet this group is feeling pretty good. And, in my experience, that the people who say, money doesn't have anything to do with happiness are people who have money. If you have money, you can say that. I've never met somebody who's really struggling that says money wouldn't make a positive difference in their life. That kind of garbage is reserved for people that have a bunch of money. That they're the ones who
Yep.
could say money doesn't matter. But I think if you go ask somebody who has $10 million what it would take to make them a little bit happier, well, I mean, what's the difference between 10 million and 11 million? I mean, it's going to have to be a big number to change things for that person. If you go to Jeff Bezos and say, what's it going to take for you to be happier? Well, it's certainly not going to be 10 or 20 billion. What does he care? It's going to be zero, or it's going to be another 100 billion. So the more, the further you are into the I have everything I need category, the less the incremental dollar is going to impact your happiness. And actually, there's a lot of research around this. And I was wrong about, I mean, I've written about the level of money you need to have to be happy. And the research used to be, I'm not going to get it perfectly right, but something like it once you have your basic needs met, you've got a house, you've got a car, you got the clothes you want, you can go on a vacation every now and then, whatever that number was, that was it. And every incremental dollar didn't make a difference. And there's a new research came out last year, says that's not correct. That original research wasn't accurate, and that the number is actually maybe 20, 30,000 higher than that. That you really need that breathing room. But then after that, new dollars have a minimal impact, and that to me segues into this study, saying like when you get to a certain level, the things that are going to move this person, make them 1 point happier, are not going to be another million or $2 million. It's going to be a better relationship with their son or daughter, or a better relationship with a partner, or something like that would have be much more important to them than what they might be able to do with a little bit more money.
Absolutely. Yeah, we talked about a few episodes ago about the new research on happiness, how it's kind
Mm.
of shifted where you kind of have to look at a person and see what they're feeling overall, what's their baseline level of happiness, and if they're
Mm.
just plain miserable, money isn't going to change it.
That's
But
right.
if they're
Yeah.
reasonably happy, more
Yeah.
money is going to increase happiness for most people. So I think that's the new updated research that is kind of more intuitive than
Yeah.
saying, yeah, you give someone $10 million are not going to be happier. I think that's kind of
Right.
ridiculous. Most people are going to be much happier. I guess the question is, how long does that increase in happiness last? And just the human nature of, we always want a little bit more, it seems like. So, talking about the secrets to a happy life, Charlie Munger just passed away this week, 99 years old. Um, Lived an incredible life, obviously regarded as one of the most successful and thoughtful investors of all time, Warren Buffett's right hand man. And he had this to say on The Secrets to Happy Life. It's my favorite quote by him, and I've talked about it in the past. Very simple here, Peter. You don't have a lot of envy. You don't have a lot of resentment. You don't overspend your income. You stay cheerful in spite of your troubles. You deal with reliable people and you do what you're supposed to do. So you're reliable yourself. And what a beautiful way to sum up. And there, if we're looking for a way to live a happier life, and as we talked about, you're waiting for more income or more wealth. Well, if you do these things, I think you're going to be more content, right? In your life, you're not going to be as worried and focused on those other things.
Yeah, I mean, it's sad to see him go. Bogle went. A lot of other heroes are getting older, and I just think it's a world that people have gotten a lot more sharp edged. There's a lot less common sense. There's a lot more selling complexity, and kind of the people that spoke the truth about investing a little bit more rational, a little more calm. Unfortunately, they're not proliferating. They're getting older, and it's sad to see one of the common sense people go, and so close to age 100. But what a life!
Yeah, absolutely. All right, so we're going to end here, Peter, as we always do with signal or noise. We have two topics today. The first one here, consumer sentiment, and pretty unusual here that consumer sentiment is this low given that we're not in a recession. The stock market has rallied, as we showed, significantly this year. Yet we have 28 consecutive months where this University of Michigan survey is below 75. That ties the period from 2008 to 2010, where we did have a recession and we had a 50+% decline in the stock market for the longest streak of negative sentiment on record. Now, this is definitely surprising, but on its face, when you look at consumer sentiment data, what's your first reaction in terms of if you have an extremely low reading or extremely high reading?
Well, I love this chart because I've written about this specific study in at least two of my books about how it's one of the best contrarian indicators that exists. When consumer sentiment is negative, the stock market tends to do very, very well after the fact. So I love it. I love to see where we're at in the cycle here with this study.
Yeah. So we're at an extreme low. What has typically happened from an extreme low? This might be surprising to some people, but the lowest 5% of consumer sentiment readings, and we're in that range today, over the following 12 months, the average return for the S&P 500, 18%. If you look at the highest 5% of consumer sentiment readings, the average return still positive, but much lower at 3.7%, definitely below average. So if you have something to be bullish about next year, I'd say, sentiment overall seems to be better than it was when we entered the year for sure. But the fact that consumers are still pretty negative is kind of unbelievable to me. And maybe watch what they do and watch what not what they're saying in terms of they still seem to be spending, the economy's still going. But if you're looking for something to be encouraged about for next year, this certainly would be one of the things. So definitely for me, a signal when you're at an extreme, and we're still surprisingly at an extreme. Okay, last one here, Peter, and this one has been a topic all year long. We've been talking about it. It's gone on now for over a decade, but the spread over the last year between large caps and small caps, 18% spread, right? Russell 1000 looking at large caps up over 9%. Russell 2000, this is over the past year, down over 8%. You got 18% spread over the past year through the end of October. And what most pundits say, right, they'll go on CNBC, they'll go on Bloomberg, and they'll say pretty emphatically that this is a bearish omen for the market, that there's weak breath, they say, that the average stock's not participating. As you talked about, the Magnificent Seven is driving everything. all the rest of it, that you should be scared that the future is going to be worse if we're looking out a year from now because of this negative divergence. So you don't know the results here. So I'm just gonna, just gonna ask your opinion, your guess. Would you think that this would be negative in terms of a signal, or is it just noise?
It's definitely noise, and if anything, I think it's positive because you take the Magnificent Seven out, large cap is much more in line with small cap. There's still going to be a gap, but half of it almost would be eliminated. And I think that what you wind up seeing is, it's darkest before the dawn, just like the previous consumer sentiment slide. That doesn't mean things are going to turn around next year, but this gap always closes. When it does, it tends to do so rapidly. We just never know when.
Okay, and so far we're in November here, almost the end of November. So far the gap has closed a little bit. There's been a small cap rally, and here's the data. I just ran the numbers, updated it before this video here. Kind of shocking here. So when small caps are underperforming the way they are today, looking at the top 10% of periods of underperformance, and we're well within that range today. Looking out 12 months from there, lo and behold, you see outperformance in the indices on average. So Russell 1000 is up 19.5% on average, Russell 2000 20.3% on average over the following year. That fact alone should be pretty surprising to most people. The fact that not only is not typically a negative indicator, it's actually a positive indicator. But how about this? When small caps are outperforming, so looking at the top 10% where small caps are outperforming that Russell 1000 index in the other direction, you actually see below average, even negative returns on average over the next 12 months. And this kind of, and people are still going to say this isn't going to, the data is not going to stop
Mm.
anyone from saying this is a bearish omen, right? Because it's just, you repeat something long enough, people believe it
Right.
to be true. But what's the underlying reason for this? There's been studies and research on it. The reason is small when a market has an extreme period of performance and you see, let's say, the market moving higher, and it typically actually starts with large caps, and then with a lag, small caps catch up to that as people get more confident in terms of the economy, other things, and as you said, that gap closes very quickly. Now, near the end of a huge rally, what you actually tend to see is the opposite. You tend to see this huge speculation and surge in smaller companies, right? People are taking more risk, and that on average has been actually worse. So it if you really think through it, it is somewhat intuitive, but it's just been the case that permanent bears will look for something to be bearish about, and this has been a persistent theme, Peter, not just this year, but the last decade,
Well, it's
right?
gone on
Small caps
forever.
have
Yeah.
it's over a decade. They've
Yeah.
persistently outperformed, and all along the way, all you have to do is look at the data to say that's not necessarily a bad thing for the overall market. And at some point, as you said, there's going to be a catch up. We don't know when. All right, so covered a lot of ground today, Peter. Thanks everyone for joining us on Signal or Noise. If you're watching this on YouTube, you can also find us on Apple, Google, Spotify, and we'll see you next time on Signal or Noise. Thank you.